Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Dan Wantrobski. He's the Associate Director of Research at Janney, Montgomery, Scott, to discuss the U-shaped recovery cycle and what to watch in the coming months. It is great to have you back, Dan. Welcome to Trade Talks.
Thanks very much, Jill. Happy New Year.
Yes, and same to you. And you think that we're going to see a formation of a U-shaped recovery cycle in the coming months. How will this be different from the V-bottoms investors have experienced in recent years?
Yeah, the U-bottom puts us in a place where, we're not too bearish for the year ahead. We're also not too bullish for the year ahead. Those V-shaped recoveries that you're talking about, there's something that investors got used to over the last 20 plus years, and they're really a function of Fed policy. In the past, every time the markets or the economy destabilized, the Fed's standard response was to come in, lower interest rates, and inject liquidity into the system as needed. And that really worked to produce those dramatic sort of V-shaped recoveries that we saw in the stock markets. And really coming out of the pandemic crash and bottom, it pushed us to new all-time highs within a matter of months, and things like the S&P 500, so on and so forth. So the difference going forward is obviously we don't have that Fed tailwind anymore. We know from last year they are putting inflation fighting as front and center of policy. They're going to continue to be pretty aggressive in raising interest rates to slow that money velocity down and help thwart that spread of inflation. And we think that's going to have this effect on the markets of, without that liquidity injection, without the lowering of interest rates, even without a pivot or a pause, we could be range bound for a little bit longer than investors like to. So you're sort of erasing that V and you're kind of replacing it with a bit of a trading range. Now, I think we're going to bottom this year. Our work does point to a market bottom. The S&P hit lows of around 3,500 last October. We think under two scenarios, you're going to place some type of bottom or platform in this market structure this year. The first scenario is a benign recession, relatively weak, right? So inflation continues to moderate and roll, but employment stays resilient and liquidity stays accommodative. If that's the case, and we have sort of really a more benign slowdown or contraction or recession, we think the lows in this market could actually have been already established. We think 3,500 could be the bottom, right, for this tape. If, on the other hand, a recession proves to be more severe, so inflation does moderate ahead, but we're also seeing dramatic increases in unemployment, right? We're seeing disruption in the labor markets as well. Then 3,500 may not be the ultimate bottom this year. We could have to break those lows, hit 3,100, 3,200 on the S&P before we sort of put in a platform or some type of bottom in the markets. In either case, we believe they are going to work to produce a bottom this year in somewhere in that 3,000 range for the S&P 500. And so for longer term investors, we're prepping them. As volatility strikes again in the new year, we want to be ready for longer term investors to use anything with the S&P in a 3 handle, right, 3,500 or even 3,200 as a pretty big buying opportunity for the next 2, 3, maybe even 4 years. We do not think the U.S. is cycling into a structural downturn here. We don't think it's going to be a repeat of the stagflationary 1970s here. We do not think that's the cycle we are working towards here. We think instead there is a reflationary expansion taking place. The equity markets are adjusting to that now. They're going to put in a bottom somewhere around these levels. It's going to produce that U-shaped trading range for a while, but eventually that bull market and expansion in the U.S. is going to resume, and we want investors to ultimately be a part of that at some point this year.
And what are your expectations for the 10-year and the dollar?
Yeah, so we label this a reflationary expansion cycle. That means we are prepping investors to be ready for a generally higher interest rate environment going forward. And we actually think that's going to last for years. This isn't just a temporary or cyclical thing. So reflation means economic expansion, multiple expansion against the bastion of higher interest rates or rising interest rates. And remember, interest rates are really coming off of historic lows. So that you kind of put that in the backdrop for 1 second. Now, for this year, we actually think there's going to be a cyclical bond market rally. We think the sell-off last year in the bond market, pushing rates higher alongside Fed policy, has been a bit overdone. So we could actually see rates move modestly lower this year. So the 10-year right now trading at about 3.5%. We want folks to watch around 340, 350. If you see the 10-year Treasury note yield breaking that, we say be prepared for lower rates in 2023. It could go as low as about 280 or maybe 3% as sort of a next support range. So you see, that is also going to cause sort of a disturbance in the equity markets, because if rates are pushing lower, it means the bond market is either trying to decipher recession, pivot, or any other number of macro uncertainties out there. And that's going to all kind of coalesce into this U bottom. So really, for both the debt markets and the equity markets in the months just ahead, we're looking for ongoing, still sort of choppy waters out there for investors.
So when you think about positioning, because of course we're coming into earnings this week with the big banks starting to report on Friday, let's shift away from the macro for a moment and focus on fundamentals. Yes, valuations have come back down, but to your point, the macro environment has gotten more challenging, especially the cost of capital. So what sectors do you want to be in as we navigate this recovery?
Yeah, so you hit on a key phrase, cost of capital. I think that's very important when you look at sector sort of relative performance. So in a reflating interest rate environment, higher interest rates, higher cost of capital, higher cost of money, value sectors tend to work a little bit better. So if the 10-year kind of hovers around 3.5% this year, but continues sort of in an upward trajectory, you're going to watch things like value continue to work a lot better. Those are things like industrials, basic materials, financials, even banks and financials, which I know are coming into earnings this Friday. We start even home builders, which has been a relative winner in recent weeks. If, however, the 10-year continues to move lower, right? So we break 350 on the 10-year note yield and rates are grinding lower in line with inflation and a slowing economy, that's your cost of capital coming down again. Watch for a resurgence, believe it or not, in growth. Growth tends to rely heavily on leverage vis-a-vis cost of capital. So as the 10-year moves lower, you could actually see things like semiconductors, even broader technology, do a lot better on a relative basis than they did last year. So it's going to be a toss-up in terms of sectors depending on rates as well in the upcoming months.
All right, Dan, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Great. Thanks, Jill.